But I think the bigger picture that investors need to be aware of is that there is a massive shift going on around the world, and it's really two-pronged. From the point of the central banks, it's a movement away from US dollars and into gold. So central banks that had heavily relied on the US dollar as a primary reserve asset, they are divesting of dollars and instead they are accumulating gold. And so that is, a big change. It also eliminates a big buyer for our treasuries. So the result of that is going to be higher interest rates for Americans as foreigners, foreign central banks are buying fewer treasuries, but also a weaker dollar. And that's going to raise the cost of goods, of imports in particular for Americans, because you're not going to have foreign central banks propping up the dollar. And it also means much higher gold prices because that's what they're buying. So lower treasury prices and higher interest rates and higher gold prices.
Central banks are strategically shifting away from the dollar toward gold, driven by heightened geopolitical risk, currency concerns, and a desire for a sovereign reserve currency that is insensitive to sanctions. Gold purchases by central banks have more than doubled, averaging over 1,000 metric tons per year, nearly twice the volume seen in the previous decade. Many banks are cementing this long-term trend, with 95% expecting overall gold reserves to grow in the coming year. Emerging economies, such as Russia, China, Turkey, and India, among others, are key drivers. This change removes a significant source of demand for U.S. Treasuries, which in turn leads to higher interest rates at home. At the same time, it puts downward pressure on the dollar, making imports more expensive for Americans. Peter Schiff, a well-renowned metal expert, highlights that investors are rotating out of U.S. stocks and bonds, seeking better value, higher dividend yields, and the benefit of a divergent economic and currency cycle abroad. The weakening U.S. dollar is amplifying returns from foreign equities, further incentivizing global diversification over home-biased investing. With U.S. markets under strain from fiscal pressures, tariffs, and elevated valuations, international markets are emerging as a powerful countertrend. This shift is gaining momentum and may endure well into the future. July marked the strongest inflows into global ex-U.S. equity funds since December 2021, totaling $13.6 billion. Now, with the dollar falling and international markets gaining strength, this trend looks set to continue for years, pushing U.S. assets into relative underperformance. At the same time, a growing chorus of investor concern warns that the U.S. may be entering an era of fiscal dominance, where the government's fiscal pressures undermine central bank efforts to control inflation and set independent policy. President Trump's push for rate cuts exemplifies this pressure, raising alarms that the Fed's independence might be compromised. The U.S. national debt surpassed $37 trillion in August 2025, a milestone previously expected only after 2030. Analysts cite emergency pandemic expenditures and the new Big Beautiful Bill as major contributors to this acceleration. Now we present the clips from Peter Schiff's interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you and enjoy the video.
But at the same time, you're seeing a shift among private investors out of U.S. financial markets, so out of U.S. bonds and stocks, into their own markets. And so that's why you're seeing this huge outperformance. I mean, for example, I think the S&P is maybe up about 9% year to date, but the Euro-Pacific International Dividend Payers Fund, which is just a fund of foreign stocks, is up 36% on the year. And that's a reflection of money going back into foreign markets. And, foreign markets have much lower valuations than U.S. markets, so you get a lot more for your money. You can buy stocks a lot cheaper. The dividend yields are a lot higher, and you don't have the weakening dollar. And so this is a major shift because for the 10, 12 years before that, the U.S. stock market was the strongest, the dollar was strong, and money from all over the world was coming into our markets. Now that money is being sucked out. and it's just beginning. So I think this is going to be a long wave that's going to continue for the rest of this decade and into the next, where the U.S. stock market dramatically underperforms the foreign markets, the mirror of what had been happening over the prior decade. So I think it's important that investors recognize this and move as much money as they can into international markets and also into other things that do well with a weak dollar: gold, silver, commodities. Those are in bull markets when the dollar is in a bear market. And I think that's where we are. The dollar has gone down a lot this year, about 10%. And so that's, really increased the relative returns on the international markets. I don't know if it's in that chart or not, because maybe we may be even higher above that downtrend. It's hard to say.
Good point. Yeah. So as we kind of see this capital rotate out of the United States and slowly find its way into the foreign markets, is that why we're starting to see, or we have seen, a huge bid on gold over the last 18 plus months? And
yeah, well, a lot of that is the central banks moving out of dollars. The United States is in a very precarious financial position. For years and years, they've been talking about this unsustainable fiscal path. Well, the reality is, we passed that unsustainability a long time ago on this path. I mean, we've arrived at an unsustainable situation. And I think our creditors recognize our inability to service this, massive debt. It's over 37 trillion now. And the Trump administration has thrown gasoline on the fire, with the big, beautiful bill. The trajectory of deficits are actually going to accelerate under Trump compared to where they were under Biden. And they already were accelerating. So the debts are really exploding out of control. The tariff revenue, which again is just a tax on American consumers and American businesses, the tariff revenue is not going to be big enough to offset the, what the government is losing from the big, beautiful bill. So the deficits are going to get worse, even despite the mitigation from the tariffs. But meanwhile, the tariffs are harming American industry. They are making American industry a lot less competitive. And they are causing a lot of our trading partners to look for ways, to avoid the U.S. And trade more with themselves. So it's more of an isolationist approach that's going to harm the U.S. economy. So it's we're making the situation worse for ourselves. So that's also one of the reasons that capital is leaving the U.S. because tariffs are making America less competitive. So why do you want to invest in U.S. companies that have to deal with all these tariffs when you can invest in foreign companies that don't? So we've really shot ourselves, maybe not even in the foot, like in the stomach or maybe the head, but the country's in a lot of trouble, and our creditors know that, so they don't want to loan us more money, and they know that the dollar's going to fall. We're going to inflate away these liabilities. And so that's where we are.
As U.S. debt burdens grow, so does the political pressure on the Federal Reserve to keep long-term yields low, despite the risks of inflation. Observers warn this could signal the onset of fiscal dominance, in which the Fed's independence is compromised in favor of supporting government borrowing costs. Analysts across major economies see potential for central banks to resume bond buying, which could raise inflation and weaken currencies. Long-term yields have recently spiked, with the 30-year Treasury surpassing 5%, the highest since 2023. This reflects growing investor concern over soaring deficits and dwindling fiscal discipline. Market participants are increasingly acting like bond vigilantes, selling bonds amid concerns over unsustainable spending trajectories. If yields climb further, 6% responses could include aggressive Fed intervention or reactive policy shifts. Should Treasury yields remain elevated, the Fed may be compelled to reinstate large-scale quantitative easing, QE, to lower yields. While QE can provide temporary relief, it tends to stoke inflation and erode the value of the dollar. Moreover, such a move helps stabilize government debt at the expense of broader bond markets, leaving areas like corporate and municipal bonds vulnerable to crowding out. Let's get back to the interview.
Because I think what's going to happen is that the upward pressure on rates is going to become a big problem for the economy, politically, especially when you see the yield on the 10-year moving north of 5. I mean, it's, only really gotten as high as 4.5, and you have the 30-year at 5. But when you get the 10-year, I think at 5 or maybe north of 5, and then you get the 30-year pushing 6, I think that's going to be very problematic. And I think there's going to be a lot of pressure on the Fed to do something about that. And so the only thing the Fed could do about that is, of course, to officially go back to a, wide scale QE program where the Fed just buys up all those bonds to force the price up and the yield down. But of course, that throws gasoline on the inflation fire. And that may be a very short-term fix, but it will blow back, at the Fed violently in the other direction. So even if they can orchestrate a short-term decline in long-term yields, they're going to blow out because the market is going to push them unless the Fed, really just pulls out all stops and does the, whatever it takes. We will print an unlimited amount of money to make sure that yields don't rise above this level. And then they open up, a trap door underneath the dollar, and then you just get a free fall and, massive inflation. And then the problem there is, yes, there's yield curve control for treasuries, but what about everything else, right? While the Fed is printing up money to buy treasuries, what happens to corporate bonds? What happens to muni bonds, right? What happens to whatever the Fed isn't buying? Those things are going to get killed. And so maybe the government gets low interest rates, but everybody else gets much, much higher interest rates. One of the reasons that the CPI is not showing price increases that result from tariffs is because it's not accurate. But now another reason is because of a lag. Look, I am a business. My costs go up. I don't necessarily immediately raise my prices. I mean, first of all, I have a lot of inventory that I might have bought before the tariffs. And so I'm not necessarily pressured to raise the prices there. I don't know if the tariffs are permanent. Are they going to go away? I mean, do I really want to raise my prices and then cut them back? I mean, let me see what happens here, because you might be reluctant to jack up prices. Maybe your competitor doesn't do it. You're worried I might lose some business. So there is a little lag as businesses try to figure out, are these price increases permanent? Are they temporary? The different things. But ultimately, the decisions are going to get made. The prices are going to be increased. Businesses will act the same way if their labor costs go up or their rent goes up or their material costs go up. They don't necessarily immediately raise their prices. It may happen months later, by the time they take a look at everything. So there's going to be a lag. So you can't just say, aha, you see, they're not, prices aren't going up, because they're going to go up. Where is this tariff revenue coming from? Obviously, U.S. businesses are paying it. Foreigners aren't paying it. Foreign governments, foreign companies, they're not slashing prices. Because if this were true, you would look at the import prices and you would see prices crashing, because the only way foreigners could be paying our tariffs, and if our average tariff rate now is 15, 20%, the only way foreigners would pay that, they would have to say, okay, America, we know you're going to get hit with this 15 or 20% tariff, so we're going to cut our prices. We're going to let American companies buy our stuff for 15 or 20% less, so that when you pay your tariffs, it's the same. But they're not doing that. Prices of imports aren't crashing. And we're paying the same as we were paying before. So American companies are paying these taxes. It's only a question of time until the customers pick up the tab, right? Who else is going to pay for it?
Global capital is shifting away from U.S. dominance. Central banks are stockpiling gold, private investors are rotating into international markets, and fiscal stress is eroding confidence in treasuries. With U.S. debt exploding past $37 trillion and yields climbing toward politically unsustainable levels, the Fed may be forced into renewed intervention at the cost of inflation and dollar weakness. This combination suggests a prolonged period of U.S. underperformance relative to global markets, where gold, foreign equities, and tangible assets may emerge as the primary beneficiaries. If the Fed reintroduces large-scale QE to suppress yields, what assets are likely to gain the most from renewed inflationary pressures? Could the accelerating shift toward gold reserves and foreign markets trigger a structural decline in U.S. financial dominance over the next decade? Please participate in the discussion and leave a comment below with your thoughts. If you found this video helpful, please like and subscribe for more videos. We appreciate the time you take to watch and support our station.